Renting is a habit that most of us are forced into because of rising home prices. And it's little known, but institutions are buying up single-family homes up at a rapid rate, leaving nothing for families to buy. And by 2030, institutions may control 40% of all single-family rentals. The reason? Jordan Ash, the Director of Labor and Jobs and Housing, says it's almost a captive market. And that's not all because a new study just came out saying millennial renters will need to save an extra 50% more than homeowners in order to retire comfortably. So today, we're going to look at institutional investing and what they're doing to the housing market and how it might affect prospective buyers. So we first have to begin with what is happening with Blackstone. Blackstone is the world's largest alternative asset manager with nearly $1 trillion under management. They just closed their fund called Real Estate Partners X Fund with a staggering $30.4 billion of investments. And Blackstone proudly calling it the largest real estate drawdown fund ever raised. And what's crazy is this fund is 48% bigger than their last fund, which also broke the record for the largest real estate fund. But this is the problem. 55% of people who currently own a home say they couldn't afford to buy their home with the housing prices as they are right now. And that's because housing prices have risen more than 40% since the start of the pandemic. And many cite one of the sources of this problem is institutions buying up all available home inventory and driving up prices. That's because last quarter in 2022, institutional investors made up 18% of all houses sold. After all, this record-breaking fund was put together to buy rental housing, which this includes the single-family homes, and they want to put them up for rent along with logistics centers, hospitality, and data centers. These institutional real estate investor firms are basically the middleman. They raise a bunch of cash from investors for a specific asset class, in this case the rental real estate market. They then go out and purchase the assets for the fund and hope that they go up in value or that they can rent them out for a profit and give the investors a return on their investment. One study found between Invitation Homes and American Homes for Rent, they held over 130,000 homes in their portfolio. And the mega firm that owns Invitation Homes, none other than Blackstone. Institutional investing in neighborhoods hasn't always been a thing. And before the 90s, investors didn't have massive portfolios that dominated different regions. And this is primarily due to the difference in technology that we have today. See, right now when you go to pay your bills, you probably log into a website or maybe it's a mobile app and then you pay your bill that way. Well, during this time period, this wasn't a luxury people had. Instead, you had to drive to your rent collection building or maybe you had to drop off your payment at the post office. Either way, there wasn't a super efficient system like that we have now. This meant that scaling large mega rental home businesses like Invitation Homes wasn't possible. And during this time period, institutional investing was much lower and they were constrained to really 3 or 5 major cities. And once the subprime mortgage crisis of 2008 hit, there were thousands and thousands of homes foreclosed on that the mega firms saw as a good investment opportunity for their portfolios. March of 2009, the Blackstone CEO would write a letter to the shareholders about investment opportunities that the group was eyeing at the time. In the midst of a deepening national recession, among the most attractive opportunities were real estate, and especially urban residential real estate. And the peak of all that buying occurred of October of 2012 when 20% of home sales were made by investors. And by 2016, Blackstone had acquired nearly 50,000 homes under the name of Invitation Homes. Tim Henderson of Pew Charitable Trust crunched the numbers from the data firms and found that nearly a quarter of all single-family homes in the US sold in 2021 were bought by investors. Now, I have heard a lot of people say, now I would never sell to a corporation. I would only sell my house to a family that really needs a home. And now that sounds nice, and I'm sure everyone on the internet totally believes you, but the reality is it's such a competitive housing market right now. And these giant funds are able to offer great deals that's really hard to turn down if you're a seller in the market. The firms will step in and they will offer a cash offer, and maybe they'll even waive inspections and offer to purchase your house as is. They're basically everything a seller wants to hear when it's time to go sell their home. And honestly, it would be pretty hard to tell them no, and that instead you would rather wait for the right family to buy your home. That catches us up on the evolution of real estate investing, especially on an institutional level. But how will the new fund impact the market? See, when mega firms start moving into neighborhoods, there's consequences that come with them. Some are good and some are bad. And I want to start off with showing you about price appreciation. It can either be a good thing or it can be a bad thing depending on who you are. If you already live in the neighborhood and the firm starts buying homes in your area, your home will appreciate much faster. Areas with large amounts of institutional investors grew about 40% over the past decade, whereas areas with few investors only grew by 34%. These firms go in and they look for communities communities that are growing and they're expanding. But at the same time, this is exactly what most Americans want. So this same interest is what is rapidly driving up the price increases. And there's nothing worse than families moving out to an area just to not be able to afford housing, but instead being forced to rent a house that they might have been able to buy in the first place if these institutions never bought them up. And these mega firms have primarily looked into the South and Southeast for a majority of their investments. And it's not coincidentally that these are the areas that the biggest population growth since the pandemic, which once again screwed over the potential home buyers and made home prices appreciate the most in these areas as well. And right now, I'm in the same boat with you guys, okay? We have been looking for a home to buy in the Jacksonville area, which ironically is one of the highest increases of institutional buyers in the country. Yay us. It sucks because we keep seeing home prices go up and up and up, and we can't afford to buy a home now because the prices have appreciated so much, and the only places we can afford are those really sketchy areas. So now we're forced to rent from another mega firm. And that brings us to the next downside of mega firms and single family houses, and that's rent. Okay, so you can't afford a house. Well, the next thing you're gonna do is you're gonna rent. Well, this unsurprisingly has led to rent rising at a fast rate in these areas too, with Realtors.com reporting that 52% of institutional investors had a higher rent for the same quality of property. Personally, I kind of think a majority of this high rent is due to the fact that most people in these same areas are seeing a large influx of people, so naturally the supply and demand laws play themselves out and the prices will go up due to competition, but this is still a factor to consider. Now, these firms are indeed probably contributing to these massive housing prices increases, taking these homes off the market and leading to a lack of supply. A study from MetLife Investment Management projected that 40% of US single-family rentals would be controlled by institutional investors by 2030. So here's my take, and I think it's an important problem to highlight, especially for Gen Z or millennials who don't yet own homes. A recent study from Canada found that renters of millennial age would need at least 50% more in their savings than their counterpart who already owned a home in order to retire comfortably, which honestly is the sad truth for so many millennials, and it's why it's so important to spread this issue. Your home is essentially a giant savings account that not only appreciates in value, but when you retire, it can be worth hundreds of thousands of dollars that can be made available to you. See, when you rent, you're essentially throwing that money away, and yes, you get somewhere to live, but you get no equity with it. When you buy a home, your money goes into the home, and eventually one day you can sell it and keep all of that money for yourself. I just think it's kind of sad. It's sad to see that people are getting priced out of the market, and I hope people recognize this and save everything possible. That way, one day they can own a home before it gets to such an unreasonable price level. Because ultimately, at the end of the day, owning a home is the best way to build your wealth. Now guys, if you found the video helpful, please give me a like. I'm such a small channel, and if you thought it was interesting, please subscribe for more. I would really appreciate it. If you want to invest in the stock market, link below for Webull. All right, I will see everyone on the next one.